Industry Leader Update. Before we jump into today's topic, I want to stop just for a moment and say what a pleasure it was to see many of you, our loyal viewers, in person in Irvine, California at Normless Western Meeting. You sincerely mean so much to me, and you make the show possible along with our sponsor. Now let's talk turkey about the HECM's interest rate floor and how today it's impacting HECM applicants and originators like you alike. In July 2018, the Department of Housing and Urban Development lowered the interest rate floor for the home equity conversion mortgage, or HECMs, from 5% to 3%. Now, this was at a time when the Federal Reserve was reducing interest rates. HUD's responsiveness to the interest rate environment and the reduction of the floor allowed new HECM borrowers to benefit from a higher principal limit factor, or a ratio of funds available when rates fell below the previous 5% threshold. Now, fast forward 4 years later to today, and most are now finding themselves longing for a return to the 5% interest rate floor. So why does the interest rate floor matter in the first place? For those unfamiliar with this unique feature of the federally insured reverse mortgage, the interest rate floor is where the principal limit factors stop increasing when the HECM's expected rate falls below the base rate or floor. However, on the flip side, the principal limit factors actually begin to decrease when the expected rate exceeds that floor. So today, that means every HECM above 3% is going to see lower PLFs, or less funds, and in today's interest rate environment, that's literally every HECM. With the 10-year constant maturity treasury rate having skyrocketed to nearly 3% in just 2 short months, and typical lender margins averaging between 2 and 2.5%, today's expected HECM rates are at or exceed 6%. Now, increasing the HECM's interest rate floor by 2 percentage points to 5% would in effect move today's calculations to be calculated by an expected rate that's actually 2% less. So to illustrate this point, let's look at the impact of a higher HECM interest rate floor would have on a new applicant. With our current 3% interest rate floor, a 72-year-old borrower with a $400,000 appraised home value and a 5% expected interest rate would have $186,800 available before they pay off their mortgage, have any fees, loan costs, and FHA insurance paid. And we call this the gross principal limit. Now, if the floor were increased to 5%, that same borrower would stand to qualify up to $235,000, which would increase their proceeds by $48,000 plus. That's a 26% increase in funds. But what if the expected interest rate was an even 6% and the floor remained at 3%? That same borrower would stand to have a gross principal limit of $166,000. Now, if HUD increased the interest rate floor to 5%, the gross proceeds would increase to $209,000, and that's $43,000 more, and again, 26% more available money. Increasing the interest rate floor to 5% could easily make the difference if a homeowner is going to be able to pay off their existing mortgage balance and qualify, and thus improve their quality of life, or be disqualified. To be fair, HUD is not punishing us with a lower interest rate floor. It's market forces, as manifested by higher interest rates. Those are putting pressure on the homeowner and originators and lenders alike. It's likely that under today's current interest rate environment that fewer lender credits are going to be available, as origination fees will adjust to protect the profitability and costs while remaining attractive to potential borrowers. And all that leaves the industry at an inflection point. As rates continue to rise, PLF factors will drop considerably. However, if the interest rate floor is adjusted at the negative impact that we see today, HECM proceeds can be mitigated considerably. Now, when would HUD actually consider adjusting or increasing the interest rate floor? Most likely not until the release of the FHA annual report to Congress in November. It should be noted that the report's reflection of the HECM's economic valuation and strong performance bode well for consideration of an adjustment, that outside accounting for any potential changes in the housing market. And that may be the impetus for the change that older homeowners and our industry alike need. Now, what are your thoughts? Leave your comments in the comment section below. And also, please share this video with others on your Facebook, LinkedIn, or Twitter profiles. We have a YouTube channel you can subscribe to. We have an entire library of all of our videos you can watch there. You can subscribe and also hit the notification bell. That way you never miss an upcoming episode. And each and every week, I met many of you who listen to our podcast when you're out jogging or taking a walk. We appreciate that. That is HECM World Weekly. Yes, we are the nation's only weekly podcast covering reverse mortgage news and commentary. and you can catch up on what's going on in our industry on your commute to work. That's it for us. Have a fantastic week, and until then, happy originating.